What if the old rules of finance are no longer enough to explain the world we are living in? Last week gave us a perfect example. Oil prices fell sharply after reports of a possible US-Iran peace framework. Stock markets rallied to record highs. Gold, which normally falls when geopolitical fear decreases, kept rising. Bitcoin crossed a major institutional threshold, and Turkey's financial risk premium continued to improve. Individually, each of these moves is interesting. Together, they suggest something much bigger. We may be watching the emergence of a new market regime. In this video, we will break down the week ending May 8, 2026 through 5 major market themes. First, the geopolitical shock that pushed oil prices lower. Second, the AI-driven stock market rally that continues to challenge high interest rates. Third, the strange behavior of gold and silver. Fourth, the regulatory turning point in crypto. And finally, Turkey's improving market outlook under orthodox monetary policy. This is not a news summary. The real question is not just what happened. The real question is, why did markets react this way? And what does it tell us about the financial system? Before we begin, this video is for analytical and educational purposes only. It is not financial or investment advice. The week's first major catalyst came from geopolitics. Reports suggested that the United States and Iran had moved toward a framework that could reduce proxy conflict and create a basis for future nuclear negotiations. Markets reacted immediately. Brent crude, which had previously climbed close to $126 because of supply risk fears, dropped sharply. In one session, it fell by around 11% and moved below the psychologically important $100 level. This was not just an oil market event. Oil is one of the most important input costs in the global economy. When oil falls quickly, the impact travels through transportation, logistics, manufacturing, aviation, retail, and eventually inflation expectations. The market was not necessarily pricing in permanent peace. That is an important distinction. What the market was pricing in was the immediate economic effect of lower oil prices. When energy costs fall, companies see relief in transportation and production costs. Margins can improve, inflation expectations can cool, and central banks gain more room to maintain restrictive policy without pushing the economy too hard toward recession. This is why the oil move mattered so much. It created a deflationary shock at exactly the moment when global central banks were trying to balance inflation control with economic stability. In other words, cheaper oil gave policymakers breathing room. For the Federal Reserve, this matters directly. The Fed has been trying to cool inflation without crushing demand. That balance is difficult. Raise rates too much and the economy weakens. Cut too early and inflation can return. But falling oil prices change the equation. If energy-driven inflation pressures ease, the Fed does not need to rush into another rate hike. At the same time, it does not need to cut prematurely. This creates what markets love most: policy optionality. And when investors believe the Fed can pause without losing control of inflation, risk assets usually respond positively. That is exactly what we saw in US equities. US stock markets continued to push higher. The S&P 500 reached levels near 7,398. The Nasdaq moved around 26,154, and the Dow approached the 50,000 level. Normally, high interest rates should pressure stock valuations. Higher rates increase the cost of capital. They make future earnings less valuable today. They usually compress multiples. But this cycle is different. The largest technology companies are not behaving like traditional debt-dependent companies. They are generating enormous free cash flow. They can fund AI infrastructure with their own resources. That means they are less dependent on cheap external financing. In a high-rate world, that is a major structural advantage. But there is a serious problem beneath the surface. This rally is highly concentrated. The so-called Magnificent Seven represent roughly one-third of the S&P 500's total market value and a very large share of earnings growth. That tells us something important. This is not a broad-based market expansion where every sector is equally strong. It is a market where capital is concentrating in a small number of companies that investors believe can turn AI into real cash flow. That does not mean the rally is fake, but it does mean the rally is fragile. When leadership is narrow, any disappointment in a few major names can create outsized market volatility. The April labor data also supported the positive market mood. Non-farm payrolls came in at 115,000, above expectations of around 62,000 to 65,000. At the same time, the unemployment rate stayed steady at 4.3%. Markets interpreted this as a Goldilocks scenario. The economy is still creating jobs, but not so aggressively that it forces the Fed into a more hawkish position. For equities, that is a very favorable combination. Growth is still alive, inflation pressure may be cooling, and the Fed may have room to wait. That is why investors continue to reward risk assets, especially AI-linked technology companies. Still, the technical picture is not risk-free. The Nasdaq's RSI moved above 80, which normally signals extreme short-term optimism. In simple terms, the market may be overheated. There are also unfilled gaps in the S&P 500 around the 6,900 area. In a negative macro surprise, those levels could become important. But there is another side to the story. Momentum indicators such as MACD still point to strong trend structure. That suggests the rally is not only driven by short-term speculation, institutional capital is still allocating toward AI-related earnings potential, so the message is balanced, the trend is strong, but the margin for error is shrinking. Now let's move to currencies. The US dollar index weakened and moved below 98. This weakness was partly linked to lower US Treasury yields, with the 10-year yield easing toward the 4.36% area. Normally, a weaker dollar should help the euro, but the euro did not gain strong momentum. The euro-USD pair remained close to 1.18. Why? Because currencies are relative. The dollar may be weakening, but Europe has its own macroeconomic problems. Markets expect the European Central Bank may need to cut rates before the Federal Reserve in order to support a slowing manufacturing sector. So the dollar is soft, but the euro is not strong enough to fully benefit. This brings us to the most interesting market contradiction of the week: gold. In theory, when geopolitical risk falls, gold should weaken. If fear leaves the market, the safe haven premium should decline, but that is not what happened. Gold remained strong, trading above the $4,700 area, with a powerful yearly gain. This tells us that gold is no longer trading only as a hedge against war or short-term inflation. It is increasingly trading as a hedge against the fiat currency system itself. Central banks, especially outside the traditional Western reserve system, are increasing their physical gold holdings. That creates a structural bid for gold that does not disappear just because one geopolitical risk cools down. Silver is even more interesting because it has a dual identity. Like gold, it can benefit from concerns about currencies and monetary stability. But unlike gold, silver is also a critical industrial metal. It is used in technologies linked to electrification, solar panels, and advanced data infrastructure. That means silver is exposed to two powerful forces at the same time. One is monetary demand, the other is industrial demand. That combination helps explain why silver has shown such extraordinary strength. In a world where technology, infrastructure, and monetary uncertainty are both rising, silver sits at the intersection of both stories. Crypto also reached an important turning point. The Clarity Act in the United States moved forward with bipartisan support. Its significance lies in legal clarity. For years, one of crypto's biggest problems was regulatory uncertainty. Investors did not know whether many digital assets would be treated as securities, commodities, or something else entirely. The Clarity Act aims to reduce that uncertainty. One of the most important elements is the treatment of stablecoin yield. Under certain conditions, stablecoin issuers may be allowed to distribute limited yield without being treated like traditional bank deposits or unregistered securities. For institutions, this matters. It gives digital finance more predictable legal infrastructure. Bitcoin crossed above the $80,000 level and strengthened its position as the institutional leader of the digital asset space, but the broader crypto market is becoming more selective. Institutional money does not usually buy every asset just because the sector is rising. It looks for liquidity, network activity, regulatory clarity, and market depth. That is why Bitcoin continues to attract capital while other networks face pressure. This is a sign of market maturity. In the early phase, enthusiasm lifts almost everything. In the institutional phase, capital becomes much more disciplined, and that discipline is now reshaping the crypto market. But crypto still carries major structural risks. The Revolut glitch was a clear warning. A system error briefly showed Bitcoin falling to 2 cents. Ethereum and Solana also appeared to crash on the platform, even though major exchanges did not experience the same move. For spot holders, such a glitch may be frightening but temporary. For leveraged traders, it can be devastating. Automated liquidation systems do not always distinguish between a real market crash and a platform error. If a leveraged position appears deeply underwater, it can be liquidated automatically. That is why leverage in crypto remains extremely dangerous, especially on platforms with weak market structure. Ethereum also showed a major divergence. Even after a successful network upgrade, Ethereum lost market share on major exchanges, falling from around 27% to 17% in a matter of weeks. The lesson is clear. Technical upgrades matter, but they are not enough. Institutional capital looks for liquidity, active users, transaction volume, and network effect. XRP showed a similar challenge. New daily addresses fell sharply from late 2024 levels, and active supply moving across the network declined significantly. The market is sending a very clear message. In the new crypto cycle, narratives are not enough. Real usage matters. Now let's turn to Turkey. Turkey's market story is one of the most important emerging market developments of this period. The BIST 100 index broke above the 15,000-point psychological level. More importantly, this was supported by stronger corporate earnings, not only inflation-driven price movement. At the same time, Turkey's 5-year CDS premium fell to around 226 basis points, down from the 241 area within a short period. That matters because CDS measures how expensive it is to insure against sovereign default risk. When CDS falls, external borrowing conditions improve for banks and companies. In simple terms, international investors are pricing lower risk in Turkey. Behind this improvement is the Central Bank of the Republic of Turkey's orthodox monetary stance. The CBRT has been keeping liquidity tight, with the TL-REF corridor effectively around the 40% level. This works like a liquidity vacuum. By absorbing excess lira liquidity, the central bank makes cheap credit less available. That helps reduce domestic demand pressure and anchors inflation expectations. The short-term cost is painful, but markets are beginning to believe that this discipline can create long-term stability. That belief is visible in Turkey's yield curve. Short-term yields remain high, but longer-term yields are lower, suggesting that investors expect inflation to decline over time. Turkey's bond market is sending a powerful signal. The 2-year government bond yield is around 37%, while the 10-year yield is closer to 33%. That creates an inverted yield curve. In practical terms, the market is saying short-term policy will remain tight, but long-term inflation expectations are improving. This is why the 10-year yield matters so much. It shows whether investors believe the current policy framework can succeed. And right now, the market is increasingly rewarding Turkey for maintaining monetary discipline. That does not remove all risks, but it does show a meaningful change in investor perception. The next week will be important. There are 3 key areas to watch. First, US CPI and PPI data. These inflation numbers will show whether the oil price decline is starting to appear in the broader inflation picture. Second, the legislative process around the Clarity Act. Any progress or delay can affect crypto market volatility. Third, Turkey's inflation report presentation by CBRT Governor Dr. Fatih Karahan on May 14th. Markets will listen carefully to how the central bank plans to manage tight liquidity while guiding inflation expectations lower. These 3 developments can determine whether the current market optimism continues or begins to face resistance. So what is the bigger message from this week? AI mega-cap companies are partly decoupling from the pressure of high interest rates because they can fund growth with their own cash flows. Gold is decoupling from its traditional role as a simple geopolitical fear hedge because central banks are treating it as a strategic reserve asset. Crypto is moving from speculation toward regulated institutional infrastructure. And Turkey is showing how orthodox policy can quickly change investor perception when credibility begins to return. These are not separate stories. They are all part of the same shift. Capital is becoming more selective, more global, and more sensitive to structural credibility. The most important lesson is this. Markets are not just reacting to headlines anymore. They are repricing the rules of the system itself. What used to be considered safe may not behave the same way in the next crisis. What used to be considered risky may become institutional infrastructure, and what used to be ignored by global capital can quickly become attractive again if policy credibility improves. That is why investors should not only ask what moved this week. The better question is, what is the market trying to tell us about the next financial regime? Thank you for watching. If you found this analysis useful, subscribe to the channel, follow the weekly market notes, and share your thoughts in the comments. See you in the next market review. If this video helped you see the bigger picture behind the market noise, subscribe to the channel and leave a comment. Which signal matters more right now? AI momentum, gold strength, or Turkey's improving risk premium?